Right, so the two critical components of a trading system, of any trading system. Number one is the idea of expectancy. I'll explain that to you soon in the next slide. The other is the question mark, and I'm going to leave the question mark till later because that is the most critical part of any trading system. And so expectancy. Basically, it's the percentage win multiplied by the average win size less the percentage loss and the average loss size. So let's kind of make that a little bit more real. Okay. So let's assume that you're an affiliate marketer and there were 10 offers that you're working with, and each one you've only put $1 into traffic, and then you have a loss or a gain that pops out the other side. So you put $1 in Google AdWords, for example, and you didn't get any hits, so you lost $1. And so let's just, in this particular case, we're looking at only 10 trades or 10 offers. And what ends up happening is that obviously you've lost $7, you've made 35. Your win percentage is 30% because of the green shaded stuff is 30%. The rest is 70% loss. The average win, which is basically that divided by 3, and then the average loss is obviously $1. Expectancy, looking back at the formula here, would give you $2.80. So what that actually means is that for every dollar you put into this system, this affiliate marketing system, for argument's sake, you're going to get $2.80 out. That's a very, very good trading system. You can go, you can go nuts. I'd borrow money to go trade this. So similarly, every business, you can bring it back down to expectancy. And that's the whole idea of this. So the percentage win becomes irrelevant if your paydays are huge. If you're getting really, really large expectancy, it doesn't really matter if you're right only 1% of the time. You're still going to clean out. So let's say if you found a trading system where 1% of the time you make $1 billion and 99% of the time you lose 10,000. The expectancy is so huge, it doesn't really, the problem ends up being more of a psychological issue because you'll be losing for months on end before you get the big payday. And you normally see that in what they call the black swan events where there are traders out there who are so contrarian that they're willing to lose months on end for a stock market burst. And they're the guys who consistently stay solvent because they're losing 1 to 0.5% a month, and then they get this 400% or 4,000% win. But it's very difficult to stay consistent with that sort of a system because psychologically, imagine you went home and you tell your wife, well, this month I lost another percent. And after 5 years, you'd be like going crazy. You'd be like, hang on, maybe this thing doesn't work. So it's the irregularity of the big wins that makes it difficult to follow such a system. Right, so I like to think of, we'll go back to the question mark later. Expectancy in business activity sits on top of that. And business activities won't matter if your business does not have a positive expectancy. So everything boils down to the one number. For every dollar in, what am I going to get out? So Crown Casino, house always wins. So you may win on a particular day, but if you go there every day, you will be bankrupt. Let's see. All right, so expectancy of marketing. So in that business that I showed you in the earlier graph where we were able to get the ROI up, we did 18 product launches, 16 were successful, 12 weren't successful. The average win was about $1 million over the lifetime. But because brands last a long, it was a business that developed brands, and those brands are still active today, so that number is understated actually, because products are still selling. But over that 8-year period, it ended up being about $1 million. And we would lose about 15 every time we got it wrong. Because you can still liquidate the product, you'd lose a little bit in marketing, but you'd kind of come out okay. So in this case, it was $59 in sales for every dollar risked. That's a very good trading system. And so once again, those kind of high ROIs you see there are a result of high expectancy. And or in the case of the $15,000, you make basically like $1 million for every 15 grand you put in, or every 15 grand that you risked, I should say. You may have invested more, but if you got it wrong, you'd walked out with only a $15,000 loss. Okay.